everyone, this is Kathy, and with me today is Peter Churchill Smith and Thomas Neustadter. And we thought it was really good timing to communicate with you and share our thoughts, our feelings, our experience, hopefully give you some information and maybe some comfort in these troubled times. The world is in chaos, therefore the markets are in chaos. How do we approach this? How do we benefit from it? And what do we see from experience, youth, and tech skills, analytic skills? So we've seen this before. We've seen volatility before. And each time I see it, I say, what next? So starting way back, September 11th, acts of terrorism, market comes down in September, goes back up by December. We've seen false accounting practices. Need I go on? Russia invading the Ukraine. The very worst correction that I've seen in my 32 years was 2008 with the subprime mortgages, where all the markets in the world, I'm pretty sure all of them, no one was excluded from this, dropped in half. So that was a very tough one, but very much a good experience, and we managed to make some money out of it. So, as I always say, it's not the markets that are correcting, it's humanity misbehaving, because people are still consuming, they're still buying things, but when you scare the living daylights out of someone, or a nation, or a country, or an entire population, you're going to see that reflected with fear in the markets. So Thomas, where I've lost track, because I look at my phone in the morning, first thing, I see the markets are in positive. And then I do a workout, I look at my phone, we're in a negative. I get to work, we're in a positive. So we've seen volatility before, but not all in one day and on social, the result of sometimes social media feeds. Like, this is a bit wild and woolly. So Thomas, please bring us up to date on where we are now. I've lost track. And I guess you have to look right now to tell us.
We certainly do. It's well, funny enough, we filmed one of these last week, and we've had a refilm last week, and then the following day the markets were up 8% on the news of the tariff pause, and then I think it climbed up actually even a little higher than that. So it really depends day to day. I remember I thought that there's something wrong with my terminal showing my quotes on my screen, because I didn't think that it was correct, but just a couple seconds later, everything was up 10.
Yeah, I thought Chris was pulling my leg when I came into my meeting, and he told me the markets were up 10%.
Yeah, so to have this level of volatility in the movement in the market is quite something. And then at its worst, we have the S&P and the Nasdaq in bear market territory, which means a drawdown of over 20%. So just what we had prior, we had the market at all-time highs when Biden turned over office to Trump. Mm-hmm. And what we saw now is that Trump has effectively taken on the world, and he's left himself with not a lot of friends, and that's the position he put himself in, which drove the markets lower. Even though earnings were solid too, we had solid inflation come down over the past couple of years. We've seen some relief with interest rates, and overall the picture of the economy looked to be solid. Maybe the market it had gone quite the run. So this was a self-induced bear market from Trump's perspective. So what we saw there is we looked underneath the hood and we looked at the fundamentals of things that we liked. We picked out our top picks and where we wanted to be, and it was, for us, it was more or less just checking off our wish list of what we wanted to add, things that were previously too expensive that we were looking to buy. So we took advantage of that at lower prices. If you like something at $100, you should love it at $80. So that's exactly what we did, and we were quite happy with the buys that we had put in, and to see the rebound here. What's going to happen over the next following months and years with Trump is unknown, but what we do know too is that he does feel the pressure of a softening stock market. He does pride himself on a good economy and on people making money, and that's one thing they campaigned on. He campaigned on lowering costs for America, making Americans wealthier, and obviously this experiment hasn't been the smoothest for him. So what do we expect going forward? We don't know, but what we do know is that we have midterms next year.
Peter does.
Yeah, Peter does. He certainly does. So we can expect the unexpected, but we're going to continue to buy when we see discounts. Yeah.
So, Thomas, last year we came off an excellent year in 2024 and an excellent year in 2023.
Yep.
2024, the NASDAQ closed up, I do believe, 30%. The TSX and the S&P up 20 and 22 respectively. So, really good returns from those markets. Where are we year to date in the TSX, the S&P, and the NASDAQ?
Yeah.
And I know it's moving as we speak, but where was it when you last looked?
So when we last looked, the quotes are quite different from a week ago because we had the TSX down 10, the S&P down 15, and then the NASDAQ down over 20.
Ooh.
What we have now is the TSX it's coming back around to almost flat. It's down 3%. We see the S&P, I believe, was down roughly 8%, and the NASDAQ trailing that, still down over 10% for the year. So we're seeing these prices come back. Obviously, investors and people are a little apprehensive to jump full swing to the market we had previously, so that's why we haven't seen a full recovery yet. Right now we're on a 90-day pause, but we seem to have made up about half that ground from that initial drawdown.
That is quite a difference from last week.
Yeah.
There was one day last week, for example, unless you were watching the market minute by minute, in 15 minutes, it started with a social media feed, and this is what we're down to, evidently, social media feeds, saying that Trump was backing off on the tariffs. All the news feeds grabbed that and put it out there. The market went straight up, almost 10%, and then it was proven to be fictitious, and the markets came right down. So if you went for a quick coffee, you would have missed the whole thing, but if you were watching your terminal, man, you saw it. So this is what we're dealing with, this intraday volatility. So this brings to mind not September 11th, it brings all the corrections to mind, but the subprime mortgages. And they corrected 3 times. The first time we weren't sure if that was bottom. The second time we felt the resistance, so there is a resistance band. So we sent out an email saying, does anyone have any money? And this was unprecedented in our experience. But we did know that when the Royal Bank of Canada trades at $25 a share with close to a 10% dividend yield, I don't think that Royal Bank's going anywhere. I think the banks have a monopoly. Yeah. And had we all but attempted the Royal in 2008, I think the current levels are probably about 160, 165, maybe 170 per share. Wow, with that yield, pretty incredible. So that's where you have to look at the flip side of the coin. For every situation that's unfortunate, or in this case, turmoil, what's the benefit? How can we benefit? It's yin, it's yang. There's a benefit in there somewhere. So it's up to us to find it and suggest it to you. So with that, we're going to put Peter on the hot seat because Thomas and I do these all the time.
Yeah.
So we're pretty comfortable with back and forth chat, but we're going to saute Peter here. Peter, can you give us some thoughts about where you think we're going?
Yeah, there's...
And when?
And when, yeah. The when I'm a little less confident to answer, but, I think a lot of people are caught up in, Trump and Trump's dictating how the markets are moving right now. Unfortunately, it sometimes feels like we shouldn't have a job when maybe we should just be buying or selling based off his tweets. But, half kidding, of course. But, I think our base case, what we think is most likely, we always plan for other events taking place as well too, and ensure that the portfolio is positioned the right way if our base case isn't exactly right. But we think the next 3 to 6 months are going to be volatile. Trump is trying to paradigm shift around trade. He's it appears he's willing to shatter the last 30-40 years of global trade and globalization that's taken place. And so I think the next 3 to 6 months are going to be volatile, as we've all said. Thomas almost took the punch out of what I was going to say, with respect to the midterms. I think what people need to realize is that the midterms are extremely important for the Republicans to retain control, and they're not stupid. They want to retain control. This can't be an issue top of mind for voters come the midterms, and that's 2 years away. Some people might be saying, what are you talking about, Peter? But they start campaigning at least a year out. So, it's our view that by November, this has really kind of got to be wrapped up, and hopefully, from Trump's perspective at least, he's got some wins so he can roll into those midterms. So I really don't think you can afford for this to go too wrong. Now, the next 3 to 6 months, I think a lot can go wrong. He's bombastic. He's trying to think of polite euphemisms.
Keep it clean.
Yeah, he's unpredictable, which the markets don't like, and we've seen that. So, once we get through that, I think we get a lot more clarity. If there's one thing we know about Trump, his machoism and his ego don't want him to have a bad track record in the markets or the economy. So I think when you take into account his corporate tax cuts that might come, and if he does gets what he wants, and we end up in a world where the U.S. has freer trade, they're re-onshoring manufacturing, there's opportunities, as you were alluding to, Kathy. We see some good opportunities in U.S. mid-caps. Yeah. We think that they're pound for pound, per unit of cash flow, well positioned right now. And on top of, re-onshoring, think that they'd be big beneficiaries of that. We like Japan as well too, for monetary policy reasons on their currency, but also valuations as well too, pound for pound, good cash flow there. And Europe, cash flow as well too, and a bit of monetary policy as well too. I like to joke that if you can get the currency right, you can let the equity risk premium kind of do the rest of the legwork for you. So those are kind of our three sort of opportunities that we see right now, and as Thomas alluded to, we're actively trading on some of those ideas the last couple of weeks. So, anything else that you want to hear from me, Kathy?
So, Trump is doing with some of his appointed people, he's doing some very interesting things, and it reminds me of my days in Ottawa when Stephen Harper arrived and said, how many people do we need in the federal civil service? And he did a very thoughtful layoff program. It was the early departure incentive and the early retirement incentive. It was very thoughtful. He went through the federal government, offered these incentives to retire early. It was orderly. We didn't see a blip in business. It's the government. I'll leave it at that. Now, Trump and Elon are like a hot knife through butter into all federal sections. And may I suggest that if you have a department that is revenue, like the IRS, departments that are collecting money coming in, you might have left the layoffs to last.
Yeah.
But how do you think this is going to affect the U.S.?
Yeah, absolutely. I think, a lot of the other things we were talking about are more short-term problems, midterm, Trump could lose the next election, or the Republicans could lose the next election, and then these tariffs go away, or like I said, they're solved by the midterm. So I think there's a cap on how long these problems can last. But I do think what's happening with DOGE or the Department of Government Efficiency, there's a longer term sort of secular problem that's taking place there. I really think that we could see a demand side recession take place from all the cutting. Now, of course, Trump said that with all the cutting, they're going to replace it with expanding the military budget. So it might kind of empty one cup and fill another. But as of right now, if they don't replace that spending, that's what demand is. It's spending, and if the government's not spending it, I think that could be quite painful in the short term, maybe to medium term. In the long term, it's we like to think that we're all better allocators of capital than the government. So I think in the long term, it's probably efficient, or it's an increase in efficiency in the U.S. economy. But it's certainly not good in the short term. Combined with this tariff war, typically, if you're a believer in Keynesian economics, you want to increase government spending if you're going to cause a recession, like the trade war. So they're kind of doing two things at once, and not a lot of people are paying attention to the cutting that's taking place and the impact on the economy. They're kind of taking political views, but we don't need to get into whether it's right or wrong. We can just get into the impact on the economy.
Right. So for any of you that have properties in the U.S., you probably are aware that when you sell a property in the U.S., there's, depending on the state, you have a state withholding tax and a federal withholding tax. And you apply to the IRS to get that money back. So you're going to look at a fair amount of time. They've never been quick on this situation at best. So we're going to see some challenges in that area, I suspect. I think this has reshaped tourism. We've seen a lot of snowbirds not go south. The US dollar was quite high. It's come down a little bit, but Trump has done something that no one else has been able to do, which is unify Canada.
Yeah.
When we look at our own provincial trade barriers, you go, what? So it started, I just saw in the news 2 days ago, PI and Nova Scotia are dropping their trade tariffs, and Ford in Ontario is talking about the same thing. So if we can get that great craft beer from the Maritimes
Yes.
to Western Canada, I think that would enhance our economy. Never mind taking wine from BC across the border to Alberta.
Yeah.
It's just silly. So I think here's some good things that are coming out of it, making us so aware of our own markets and trading inside Canada. I think we're quite complacent. And I was just over in Europe skiing. It was beautiful. And the atmosphere in Europe, I was skiing with a bunch of Brits, was why don't we just trade amongst ourselves? And I said this to Peter the other day. So Trump has unified the world against him, and we can just trade amongst ourselves and we'll be fine. And Peter had some interesting statistics.
I forgot to mention that. Thanks for bringing it up,
Yeah.
Kathy. I believe it's 22 trillion of global consumption is done by the U.S. and the next top 10 countries combined don't spend as much as the States. So as much as we'd like to say that we're going to replace our trade with other places, I'm sure we'll do it marginally in the short term, and that'll add up over time, 10, 15, 20 years. But there's no silver bullet to this problem. People are going to have to go kiss the ring of Trump and plead their case and get the trade deals they want done, because the U.S. makes up most of the world's consumption, and it's the reality we live in.
They do love to consume, and I think Canadians are second behind that. So yeah, that's a huge trading issue. So we'll see. And as you had a really good point the other day about as people step forward, as countries step forward and negotiate with Trump, their new tariff situation, maybe we'll see some stability. What's your thoughts on
I
that?
think, of course, he's so unpredictable, referencing
yes.
Trump, of course. But, in some of his speeches, he's referenced about creating a freer trading environment for the world. And so I think there is a pathway if he accomplishes some of these things where we have, there's a global growth story where, China subsidizes or historically subsidized solar, or, countries manipulate their currencies to have, advantageous trade. And so these are some of the things that Trump's alluding to. And, this sort of bad practices when it comes to trade. And I think if some of that can be, unburdened, I think there's a pro-growth story there. Now, do I trust Trump to do that? I don't think so. But if he accomplishes what he wants, what he says, then I think there's a reason to be optimistic there. Again, we're kind of focused on the three other areas that I talked about, because we don't just need Trump to excel in those areas for those trades to potentially be beneficial.
Mixed bag.
Yeah.
Thomas, you have a bit of a reassurance to our clients that are retired.
Yes, yeah.
So when you're young and you're going for it, the best time, the time I always say, I love to buy into the market when it's high because it's so exuberant, it feels so great. That is the worst thing of all to do. When we're in this situation where prices are low and you're a little bit tenuous, as Thomas said, if you like it at $100, you're gonna love it at 80. This is the time to buy. And Thomas is very analytical, and he's got his eyeballs right on the market. And if we're buying stocks, singular stocks, we buy them at that moment. So this is a great opportunity when you're in growth mode. But for our retirees that are depending on our paychecks, we're your paycheck, and we take this really seriously.
Yeah, no, we over the past couple of weeks we've seen clients reach out, Kathy, Thomas, how's my water cooler looking? And that's often a term that if you've been a client or someone's come in and met us, Kathy often refers to the water cooler, talking about our short-term money, medium-term, long-term. We do it this way so we don't have to touch our long-term investments. We buy and hold. We like something, we don't want to sell, panic sell. And for our retirees, we keep 2 to 3 years payments at the bottom of that water cooler. So regardless of what happens in the market during that short-term stretch, we don't have to sell anything long-term at prices that we don't want to sell at. So we always keep things staggered like that. Cool at the bottom. Paychecks are first, what's coming out of your account monthly, and then the next thing, and that's a medium-term bucket. Maybe there's something on the horizon the next 3 to 5 years, and then we certainly don't want to touch anything that's our long-term growth, your investments. As Peter and Kathy talked about, something like the U.S. mid caps, we definitely don't want to be trimming something like that. If we bought it at this point, a couple years down the road, that's a 10-year buy for us. And we've talked about other investment opportunities that we've talked about or ideas that we've discussed here. And those things are things, if we buy it, we're not looking to hold it for 3 years, we're looking to hold it for 10 plus. So those are things on the top of our water cooler, but our clients are really well insulated. 2 to 3 years always of payments at the bottom of that water cooler. So regardless of what's on the news, you don't have to worry about it because your paycheck is coming.
Your paycheck's golden.
I should maybe adopt your analogy. I try to explain bond ladders and duration schedules to clients, and maybe there's a simpler story in
Water
there.
cooler.
Water cooler.
I've had clients I still have my very first client, Sue, and that water cooler, I think in my first 5 years in business, became such a great analogy, and it's still quoted back to me from clients of that duration. How's my water cooler? So we hope this gives you some comfort. We're seeing some areas that we feel, and I want to talk about last fall. We had 2 great years on the NASDAQ, and we had a fair exposure in the NASDAQ. And we started last fall, early last fall, probably at the beginning of September, when meeting with you, just taking some profits out of that NASDAQ tech sector and putting it at the bottom of your water cooler. So we've been working on this well in advance, because when something's high, it only makes sense to trim some profit and put it into your withdrawal pot. So where we're kind of seeing some opportunity, and just know that you're all a custom portfolio. We have some different situation stocks, mutual funds, ETFs that we love, but your portfolio is very much custom to you. So if we're doing something, we review your exact portfolio. But I would like to say that you can probably never go wrong with our Canadian banks. They're a monopoly, and they give us a dividend yield, and they're the backbone of our portfolios that hold the whole body erect. And each quarter we get those dividend yields, and if the stock is down, those dividend yields buy the stock at a better price. So they're a monopoly. I love them. I think that's a pretty good area to look at. If we're looking at, if you're not overexposed in technology, it's very easy to be overexposed because of the phenomenal performance the last 2 years. NASDAQ last year 20%, 30%, and the year before about the same. Then if you're not overweight in technology, maybe it's time to insert some while the prices are low. And I saw the Bank of Canada today held rates, but if the economy has a downturn, they're going to reduce interest rates yet again, and those are absolutely perfect for bonds. It's not often I promote bonds,
Not often
but
at all.
no, when interest rates are dropping, this is the time to buy them, not when they're rising. So any concluding remarks, guys?
Got through a lot. That was good. Yeah.
I'm good.
Yeah.
We hope that we gave you some really good information. We hope that you know we're right here for you. Just shoot us out an email, give us a phone call. It's always great to connect with you. If you're the slightest bit uncertain, please don't hesitate. Our job is to keep you safe, get you a great retirement, ensure that you have lots of fun and lots of trips in retirement, and we really care about you and your portfolio and your families and your lifestyle. So please don't hesitate. We hope this has been of value. Thank you.